that the longer money is invested for, the more time it has to be able to compound. By having those guardrails and having the rules of preservation allows us to have the investment for a long period of time, which gives it the best opportunity to be able to grow to something substantial to be able to support us in retirement.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. We are back again and we are here again for another episode of the 360 Money Matters podcast. Where else would you rather be?
Another day, another podcast, Andrew.
Exactly right.
Would rather be nowhere else.
Other than maybe relaxing on a Greek island with a cocktail in hand, but with a microphone between us so that we can still podcast.
That's it. We're that committed, I must say, that committed to coming out every Wednesday over the airwaves to our viewers and our listeners, talking about enthralling topics. And on that note, Andrew, what are we talking to everybody about today?
So today we're talking a little bit more technical, and we're talking about super contributions. We're talking about concessional, we're talking about non-concessional, basically before and after tax super contributions. What are the difference between them? How does it actually operate? What are the limits as to how much you can actually contribute? And why would you do one over another, depending on your situation and what situation would lend itself to one or another? Mm-hmm. So, Bills, let's kick us off with, before we even go into deductible versus non-deductible super contributions, why would you contribute to super at all, above and beyond what your employer is obliged to make your standard 11% SGC super contribution?
This is such an interesting topic and such an interesting question because you don't necessarily pay a lot of attention. This is a generalized statement. Yep. Pay enough attention to your superannuation until you kind of realize the power of it, and or you get closer to accessing it, which will in turn answer your question. The reason is, first and foremost, I think, is to save for your future retirement. So the idea is that you've got a pool of money that is preserved in a tax concessional environment to be able to grow your wealth to eventually provide means in the form of an income or money at some future point in time, i.e. you being retired.
Yep.
That's the first thing. The second reason is there's some tax advantages to doing that, not only in terms of the money that's inside the superannuation environment, but also when you're putting money inside it as well too, depending on which way you put it in. And thirdly, I think from an asset protection perspective, this is probably not as well known, but superannuation, as long as it's not used to shield money from creditors, if something happens and you're being pursued by creditors in the event that maybe you needed to declare bankrupt or anything like that, your superannuation does not form part of that. So there's also an asset protection mechanism to it as well. But I think ultimately it's the primary purpose that we talk to people about is to basically have, or putting money into superannuation today to have a better lifestyle and more income and more money tomorrow.
Yep, absolutely right. So tax is really one of the big ones, and the other thing is to have a pool of money that you can actually draw down on and utilize.
And then the asset protection piece as well too
is a good little bonus on the other end of it.
Yep.
But look, let's talk about what are the different types of super contributions. So there's concessional. Mm-hmm. And then there's non-concessional super contributions.
Correct.
Yeah. So concessional super contributions are a before tax contribution towards super. So when your employer is making a super contribution on your behalf, that's regarded as a concessional contribution. Now, you can also make concessional or pre-tax contributions above and beyond what your employer makes. So you can do it via salary sacrifice, or you can even contribute yourself after the money's in your bank account and claim a tax deduction on it. What that means is, let's say you make $10,000 in concessional super contributions above and beyond what your employer makes into your super fund. That $10,000 over the financial year, or that $10,000 that you've put into superannuation, reduces your taxable income. So if your taxable income was, say, $100,000, you'd essentially be taxed as though you were earning $90,000 if you put $10,000 towards superannuation. Yep. So you're getting a deduction on the amount of money that goes into superannuation. As it goes into the super fund, you are paying tax on it though.
Correct.
And you're paying tax at a rate of 15%. Unless you're
in the fund, within the fund itself.
Within the fund itself. Yeah. Unless, and I'm for the purposes of just purely making it easier, unless you're earning over $250,000 and paying Division 293, but I'm going to forego that for the time being. And so the tax saving on putting an amount of money via a concessional contribution into super is the difference between essentially your marginal rate of tax, so the income tax rate that you'd pay, and the superannuation tax rate at 15%. So let's say you're on a 32% tax bracket, you make a contribution into superannuation, you pay 15% tax on the way in. So your benefit is essentially 17% is the net tax benefit of every dollar that you're putting towards it.
So just to clarify a little bit of the terminology, Andrew. So a concessional contribution is just, the word concessional is essentially concessionally taxed.
Yeah.
Whereas when we talk about a non-concessional contribution, it's a non-tax contribution.
Yeah.
So just to clean up that terminology, we do have limits on how much money the government allows us to put in from a concessional perspective. So each and every year, it's $27,500. And like you mentioned, it's made up of your employer contribution, so your SGC, your super guarantee contribution, and then anything that you put into your super fund, either through salary sacrifice or contributions that you make that you claim a tax deduction on, you're capped at $27,500. There are opportunities to be able to catch up and put additional above and beyond the $27,500. Few parameters around that. Within the last 5 years, you've got room in your cap, meaning that you haven't used your whole $27,500 in some of the years leading up to that over a 5-year time frame, and your balance is less than $500,000.
Yep.
So that's really there as a mechanism to try and encourage people to boost and bolster their superannuation fund.
Yep, absolutely. And then above and beyond that, there's non-concessional.
And then there's non-concessional, which is essentially a fancy word for a non-taxable contribution. So the example that Andrew was using before about working a concessional contribution and getting a tax arbitrage opportunity by foregoing or not paying your marginal tax rate, but paying the 15% tax rate that applies in super. In this instance, what you would be doing is making a contribution with after-tax dollars, meaning that you've already been taxed on it from an income tax perspective and putting that into superannuation. Yep. Now, because you've already been taxed on that money, the superannuation fund does not levy a 15% tax rate on that money when it gets contributed into the fund itself.
Yeah. So basically, the dollar that you put into your super fund is a dollar contributed to your super fund. There's no deduction, but there's no tax contribution, or there's no tax on the contribution that's also made into it.
Correct.
You're basically just taking money from one hand and putting it into superannuation on the other hand.
Yep.
A question we often get asked is, that kind of doesn't really work, but a question
Coffee time.
Yeah, exactly right. A question that we do often get asked is, okay, if I make a concessional contribution or a non-concessional contribution, does it change how much or when I can actually withdraw money from superannuation? So if I, let's say, choose to put money in now, does it actually mean that I've got access to that money above and beyond what my employer contributions, or is it just, if it's in super, it meets superannuation laws, and so your accessibility of it doesn't matter?
I'd hate to bust your bubble, but it makes no difference.
Exactly right. Just testing you.
Think back in the back in the day, the rules around accessing superannuation were very, very lax. In the earlier stages of the superannuation system, that's not the case. There are certain times that you can take money out. Those are under dire circumstances essentially, because superannuation is designed for one purpose, to save for retirement income. So the guardrails that sit around it, the rules of preservation that sit around it, are very, very tight and very, very stringent, because going back to investing principles, that the longer money is invested for, the more time it has to be able to compound. By having those guardrails and having the rules of preservation, allows us to have the investment for a long period of time, which gives it the best opportunity to be able to grow to something substantial to be able to support us in retirement. Yeah. So Andrew, back over to you. The non-concessional contribution, there's a different cap or a different limit that we can apply in terms of putting money in. What does that look like, and why would we do, one over the other?
Yeah. Well, so the cap on a non-concessional contribution, so the limit is $110,000 each and every financial year. In the opposite way to concessional contributions, where you look backwards and have an opportunity to catch up what you haven't done in previous years, non-concessional works in the opposite way, in that you look forwards. So you can bring forward 3 financial years into one and then not contribute for the other 2 in non-concessional. So in essence, you could do a $330,000 contribution in this financial year and then nothing for the next 2 financial years. If you time it correctly, you can pretty much reduce that time frame to contributing $300,000 once, then only having 2 years where you don't have the ability to contribute in the third. So it's not from the time that you make the contribution, it's from the financial year that you make the contribution. So if you do it on the 29th of June, well, then all of a sudden your opportunity is not on the 29th of June 3 years away, but on the 1st of July 2 years away. Why would you do one or the other? It ultimately depends, and we'll run through some actual specific examples as to which side favors one or the other. But it depends on your scenario, it depends on your strategy, and it very, very heavily just depends on your circumstances. But generally speaking, when you're trying to get a large amount of money into superannuation, in an example that Billy alluded to at the start, which was I'm approaching retirement, I've recognized that superannuation is a really, really powerful asset, and I want to drive as much money into that environment because it's going to be a zero tax environment once I eventually retire. I need to put money in quickly. Well, usually your best bet is going to be non-concessional contributions, because your non-concessional contribution caps are significantly larger, and they're also not eaten into by employer contributions into your fund. So you can essentially time it and say, okay, I'm going to do 110 now, 100 or 330,000 in the next financial year. So in that example of 29th of June, you do 110,000, and then on the 1st of July, you're doing 330,000, and you can quickly bundle in $440,000 into superannuation. So a non-concessional contribution would usually be a preference when you're trying to push in as much as you can, as quickly as you can.
Just doing a quick calculation here, Andrew, because I want to use a work example on that. Say, and once again, why would you do it? Getting money into super. But going one step further is you would be doing that because when you draw income, so when you reach preservation age, when you can access your superannuation, it's taxed at 0%. So let's just assume we did that strategy, $440,000 went into superannuation, and the next day you retire, right? If we didn't put that money into super, actually, let's play it the other way. If we put that money into super, and I'm going to use some really simple numbers here, and we've got $440,000, and we generate a rate of return of 10%. That's $44,000 in terms of the return that we would get. Inside super in pension phase, that is taxed at 0%. So that $44,000 gain is essentially no tax, it's $44,000. If you had that money and it was invested in your own name outside of the superannuation environment, and we got a same rate of return of $44,000, we would get taxed as if we were earning $44,000.
So if you've got, let's say, an investment property that's also generating an income, you're at a 32% tax bracket, you're talking about paying, circa almost $15,000 in tax.
Yep.
Fairly significant difference. And this is year on year. So we're not talking about one $15,000 tax saving. We're talking about $15,000 per year until, touch wood, the day that you eventually pass away.
Yep.
Which is massive.
So to use a worked example of why you'd put money into superannuation, and it's always this trade-off between using the money today versus locking it up for your future self tomorrow. But at a particular point in time, that dial switches and you very, very soon realize that the more money that you can have in superannuation at a 0% tax rate, as it currently stands, unless our government and our Prime Minister decides to break some more election promises.
Billy's still dirty about that one. He's still on last week's podcast topic.
You can't beat that tax environment.
Yeah.
So I guess that's probably black and white, the main reason why you'd consider putting money into superannuation. And really, using the mechanisms of concessional and non-concessional, yes, there are some advantages to doing it concessionally because it does impact the amount of tax that you pay in your own name.
Yeah.
But ultimately, if you're fortunate enough where you've got a lot of money to put in, there are limitations and guardrails around how quickly you can get that money in as well too. So, you may be doing a combination of both because you're trying to maximize how much money that you can get in with the eventual plan and strategy to have as much of your wealth inside superannuation where it is taxed at 0%.
Yeah, which is probably the perfect stage for a second example. So let's say, Billy, I'm in my mid to late 50s. I've decided that I'm going to sell an investment property. Mm-hmm. I've made a significant capital gain.
Yep.
And so my retirement time frame is relatively close. I want to pump money into superannuation. What would you then do in that scenario? Concessional, non-concessional, or how is that worked example any different when you're making a capital gain and you're essentially also trying to put as much money into super as possible?
I mean, look, if you're putting a concessional contribution in, you've got the limitations of the cap. And they're, relatively speaking, they're quite low. In that example, you're looking at your total income that you've got. So if you're employed by somebody and you sell this investment property that you're talking about, your employer will be putting in your super guarantee contribution, moving you towards that cap anyway.
Yep.
So you're going to need to figure out what you've got available in your cap above and beyond whatever work pays in for you. You'd want to maximize that up to the 27.5, subject to any catch-up contributions that you've got. And then above and beyond that, you'd be then looking at doing a non-concessional contribution and trying to move as much in as you possibly can. That's the way to do it. Or what you could do, depending on what's happening in future years and employment that you've got, you may decide to hold back some to try and then maximize the cap. Maybe your employment situation's changing. Maybe you're going from full-time to part-time and you're going to hold a little bit back to then try and put some more in the following year. It really depends on your circumstances. But if you're trying to get money in quickly, it's working your way through concessional caps first, maximizing that, and then moving to non-concessional afterwards.
Yep. So basically use as much of your catch-up concessional contributions as you can in a year where your income is high.
Yep.
And then move on to non-concessional contributions thereafter, in order to be able to put as much money as you can into your superannuation environment. One of the considerations, which I have seen someone get caught out with it before, is your concessional contributions or your catch-up concessional contributions. Mm-hmm. The balance that you need to have in order to be able to do it is $550,000. So if you're going to be using your catch-up concessional contributions, you need to make sure that on the 30th of June of the previous financial year that your superannuation balance is under $550,000. And so there are instances where you might want to put a non-concessional contribution in that financial year, but you also want to be able to use your catch-up concessional contributions. Yeah. You need to make your catch-up concessional contributions first, mm-hmm. so that you're not above that $500,000 balance, and then maybe in the next financial year, once you're over that, that's when you start utilizing your non-concessional. So it is a very small technicality that you can get caught up or caught on. And so making sure that you're getting some quality advice is important within it.
Yeah, it's very easy to trip up when you're talking about caps and what's going on and how much you can put in, because you actually need to look back and see what you've done in previous years as well too, to make sure that that's not going to impact you from that perspective. There is another opportunity for something that we're seeing popping up a little bit, being the downsizer contribution as well too. Yeah. So this is designed to try and, designed specifically for people who are selling their owner-occupier, downsizing or releasing some equity as part of that, and trying to take the equity that's usually tied up in a family home and putting that towards generating income. So the theory is that you've got somebody who's downsizing their house, they release a little bit of equity, and there's an opportunity to be able to put that into superannuation outside of what we were describing between the concessional and non-concessional caps, and being able to put that into superannuation. The current limit for everybody is $300,000. So if you've got two members of a couple, you can put in $300,000 each, giving you a total of $600,000. It needed to be your primary residence for at least a 10-year period. And other than that, there's not very many restrictions that sort of sit around that. You need to be over the age of 55 to do it. So it needs to form part of like a retirement strategy. But that's another opportunity to be able to get a fairly significant amount of money into superannuation.
And not being impacted by these caps.
In one go, without being impacted by these caps. And then throwing back to that worked example, Andrew, around what we were sort of talking about before. If you put in $300,000 and then you consider if you had that money and downsized and invested it in something and you were getting a rate of return and paying tax in your own name, you start to see how quickly that the superannuation tax environment plays such a big impact in terms of calculating, I guess, how much income you get net after tax at the end of the day.
Yeah, absolutely.
It's huge.
Absolutely. There's also some differences as well, Bills, as to when you're contributing as a concessional or a non-concessional contribution. If in the eventual state that your beneficiaries were to receive that money, there's some differences in the tax status of them and how that money's taxed. Do you want to run us quickly through that?
Yeah, so if you think about it in a really simplistic concept, if you've paid tax on the money, so if you put it in as a non-concessional contribution, being an after-tax contribution, the government recognise, or the superannuation system and the government recognise that you've paid tax on that. So when that eventually gets kicked out to your beneficiaries, regardless of your class of beneficiaries, it's already been taxed fully on the way, I guess, into superannuation. So there's no tax for your beneficiaries at the end of the day on money that has been contributed in a non-concessional way. So getting a little bit more technical, inside super, when you've got your balance, there's also a breakdown between how your contributions were made. You wouldn't necessarily understand or know what this looks like unless you dig and look for it. But that's taken care of in terms of sort of two different buckets, if you'd like. On money that has been concessionally taxed, depending on who gets it as a beneficiary, then also gets taxed as well too. So as an example, if you put in money to superannuation, you get taxed at 15%, and your spouse eventually gets the money, they recognise that because it's almost an extension of the same person, there's no tax on that money. But if somebody else, like a child, and we're talking like an adult child here, gets that money, they're going to be paying tax as well too, because the government don't want to miss out on the fact that they've only taxed that amount of money 15%.
Yeah.
But in saying that, we've got strategies around it. Andrew, you want to talk us through a recontribution strategy?
Yeah, I mean, look, we'll give the quick rundown because it's probably a podcast in itself, but
next week.
Yeah, exactly. A recontribution strategy is whereby you're effectively, let's say within your superannuation, you've got a balance and all of that money is taxable. It's all gone as pre-tax contributions because you've salary sacrificed, because your employer's made contributions and you wanted to claim a tax deduction along the way.
So it's gone in as concessional contributions.
Correct.
Yep.
If all of that money was to be paid out to a non-tax dependent, which in most instances is an adult child, that money would be taxed, generally speaking, at a rate of 17%. Now, it's not at all uncommon to see someone with a $500,000 superannuation balance. And when you're talking about $500,000 in superannuation and you're talking about paying 17% tax on $500,000 inside superannuation, that's $85,000 in tax. So one of the crafty methods to be able to avoid this is to, within the limits, and so this is something that would normally happen over the course of a number of years.
And this is a completely legal,
100% legal.
100% legal strategy as well. And it's something that every advisor that's worth his weight or her weight should be able to be able to discuss that.
So you pull that money out of superannuation, and because you've pulled the money out after you've met a condition of release and after you're potentially, either over the age of 60 or 65, you're paying zero tax on the money as it comes out.
Mm-hmm.
Then the very next day, you're putting that money back into superannuation, but you're putting it back in as a non-concessional or an after-tax super contribution. Because it had gone in as a non-concessional superannuation contribution, that money is tax-free. And so if your beneficiaries, your adult children, were to receive the proceeds of your superannuation estate, they would pay zero tax.
Yes. So essentially what we're doing is recycling the money, essentially taking it out of super, changing the tax status and putting it back in. And then the superannuation fund recognises that as a non-concessional contribution. So when eventually non-tax dependent gets the money, it is charged or it is taxed at 0%.
Yeah.
So in that instance, using $500,000, and I think you said 85,000 is the tax rate, roughly speaking on that.
You're talking about saving $85,000 to your beneficiaries.
Huge amount of money.
Yeah. And I mean, we're in an environment now where legislated superannuation contributions that are mandatory have been not really in effect for an entire generation, or they definitely haven't been in effect for an entire workforce.
Yep.
It's not going to be uncommon for people to have $1 million in superannuation by the time that they retire.
Yeah.
And you then look at a strategy like this for someone that's got, $1 million in superannuation, you're talking about saving $170,000 tax to your beneficiaries by simply pulling money out and putting it back in. The difference is absolutely insane.
It's not that simple. It's very complicated. You need to get advice.
Look, it is, because you need to make sure that you're within your tax limit. You need to make sure that you're also quarantining the money that gets put back in. So it is easy to stuff it up, but it's something that any half-decent advisor should be able to do and manage effectively.
Yeah. Andrew, on that note, I think we did that one a lot of justice, a few technical terms in there, but hopefully we managed to explain that and didn't get lost in the terminology. Thank you once again for today's podcast. Always a pleasure.
Jules, thank you. Appreciate it. Thanks to all of our listeners, our viewers, and we look forward to catch you on the next one. Please like, subscribe so that you're receiving updates on our new podcasts, and we will see you again in the week.
Thanks. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.